I've seen more traders lose money by grabbing it too fast than by letting a loss run. That may sound backward to you, but the market has a way of punishing impatience far more consistently than ignorance. I learned early on that the hardest thing in speculation isn't finding the right trade, it's staying with it. Anyone can buy something that starts to move. The real test comes when it moves in your favor and starts whispering, "Take it now. Don't be a fool." Have you ever watched a position climb steadily candle by candle and felt your hand twitch over the sell button? Of course you have. Every trader has. The tape starts acting right, the chart confirms your idea, and suddenly your open profit feels heavier than any loss ever did. That's when fear puts on a clever disguise. It doesn't feel like fear. It feels like wisdom. It feels like prudence. It tells you that a bird in the hand is better than two in the bush. But markets don't reward clever sayings. They reward sitting still when you're right. When I studied price movements, I noticed something simple but cruel. Big money is not made in the buying or selling. It is made in the waiting. Yet most traders never give their trades time to prove they deserve patience. They sell because the profit looks large compared to what they're used to making, not because the market has told them the move is over. Ask yourself honestly, are you trading the chart, or are you trading your own comfort level? The market doesn't know you're in a trade. It doesn't care that your account balance looks better today than it did yesterday. Price moves based on supply and demand, accumulation and distribution, continuation and exhaustion. When you take profit too early, you are not responding to market facts. You are responding to emotion, usually fear of giving back what you've just made. I learned to watch how trends behave when they are healthy. They don't collapse without warning. They pause. They shake out weak holders. They test your conviction. A strong trend will often look most dangerous right before it resumes. That's the moment when volume dries up, price moves sideways, and your profit stops growing for a while. That's when many traders panic and cash out. They tell themselves they were disciplined. But were they? Let me ask you something. If your original reason for entering the trade is still valid, why are you in such a hurry to leave? This is where most traders fool themselves. They plan their entries with care, studying charts, patterns, and conditions. But when it comes time to exit, they abandon their plan and listen to their nerves. They measure success in points captured, not in how well they followed their method. Over time, this creates a dangerous habit. You start cutting your winners short and letting your losers linger, hoping they'll come back. That habit will drain an account faster than a bad market. The great movements, the ones that build real equity, don't announce themselves with fireworks at the start. They begin quietly. They grind higher or lower, pulling back just enough to test resolve. If you take your profit at the first decent push, you remove yourself from the very move you were trying to catch. You become a spectator while others ride it to completion. Have you noticed how the market often keeps going after you exit? It's not personal, but it feels that way, doesn't it? This is not about greed. Greed is staying in a trade when the market has clearly turned against you. Patience is staying in a trade when the market is behaving exactly as it should. There is a difference. And it's written on the chart if you're willing to read it. Higher highs and higher lows don't mean get out. They mean stay with it. Lower highs and lower lows don't mean hold and hope. They mean admit you're wrong. The money mindset of a successful trader is built on respect for probabilities. You cannot force the market to pay you on your schedule. You can only position yourself to benefit when it does what it has done countless times before. That means accepting that open profit will fluctuate. It will feel uncomfortable. It will test your confidence. That discomfort is the price of admission. I used to say that the market is designed to fool the greatest number of people the greatest amount of time. Taking profits too early is one of the easiest ways it does so. You feel smart in the moment. You lock in a gain. You avoid regret, or so you think. But over a series of trades, that behavior leaves you underpaid for being right. What happens to your account if your losses are full, sized, but your wins are always trimmed? You don't need a calculator to answer that. Chart reading is not about prediction. It's about observation. When you see a breakout hold, when pullbacks are shallow, when volume supports the move, the market is telling you something. It is saying the path of least resistance remains open. Exiting early in those conditions is like leaving a race while you're still in the lead because your legs are tired. And yes, there will be times when the market takes back part of your profit. That is unavoidable, but the trader who fears giving back profit more than he desires to participate in a full move will never see the kind of equity curve that grows steadily over years. He will see spikes and stalls, excitement followed by frustration. So the next time you're in a trade that's working, pause before you act. Ask yourself, has the market actually changed, or am I just uncomfortable being right? That question alone can save you more money than any indicator. The market rewards those who can sit through the dull parts, the quiet parts, the parts where nothing seems to be happening, even though everything important is unfolding beneath the surface, and that's where most people get up and leave. Small wins cannot compensate for full-sized losses over time, and that truth is one of the hardest lessons a trader ever learns. At first glance, steady profits feel reassuring. You take a little here, a little there, and the account balance inches upward. It feels controlled. It feels responsible. But have you ever stopped to calculate what happens when one bad trade wipes out 10 of those careful gains? Most traders don't. They trade by emotion, not arithmetic. When you consistently take profits early, you are shaping the math of your entire business. Trading is not about being right often. It's about what happens when you are right compared to what happens when you are wrong. A trader who wins frequently but wins small is standing on fragile ground. One slip, one lapse in judgment, one market shock, and the structure collapses. Think about how losses really occur. Losses don't usually come from calm, planned exits. They come from hesitation, from hoping, from refusing to accept that the market has changed. That hesitation turns a manageable loss into a full-sized one. Meanwhile, your winners never get the chance to grow because you never let them breathe. Does that sound like balance to you? The market doesn't care how many winning trades you've had in a row. It only cares about price. If your losses are allowed to run to their logical conclusion while your gains are cut short at the first sign of discomfort, you've created a system where time works against you. You may feel productive. You may feel active. But you are slowly draining your edge. This is where many traders fool themselves with percentages. They say, I win 70% of the time. That sounds impressive, doesn't it? But what if the average win is small and the average loss is large? What if one loss equals 5 or 10 wins? Suddenly that high win rate doesn't look so comforting. The market isn't impressed by confidence. It only responds to structure. Ask yourself this. If your best trades only pay you a fraction of what your worst trades take away, how long can you survive? This imbalance usually comes from fear disguised as discipline. Taking a quick profit feels like control. It feels like certainty in an uncertain environment. But certainty is an illusion in trading. The only real control you have is over how you manage risk and how you allow opportunity to develop. When you cap your upside too early, you're choosing emotional relief over mathematical sense. A proper trend, once established, has the potential to pay for many small losses. That is its job. Trends are rare, but they are powerful. When you cut them short, you deny yourself the very mechanism that keeps traders profitable over time. You're left relying on frequent accuracy instead of favorable odds, and the market has a way of humbling that approach. The uncomfortable truth is that big losses don't require many mistakes. They only require one moment of weakness, one time you refuse to exit because you don't want to admit you're wrong. That loss will not politely match the size of your previous wins. It will take what it needs. And if your wins have been trimmed again and again, there is nothing to absorb that blow. This is why seasoned traders focus less on how often they win and more on how much they make when they're right. They understand that being right is a resource, and wasting it is costly. A good trade deserves respect. It deserves time. It deserves space to develop. Cutting it off early because you're afraid of losing unrealized profit is like abandoning a sound investment because the first pullback makes you nervous. Have you noticed how calm you feel when you close a small win and how heavy you feel when you sit through a loss? That contrast trains your behavior. You start chasing the feeling of relief instead of the logic of probability. Over time, you build a pattern: quick exits on strength, slow exits on weakness. That pattern doesn't show up immediately in your results, but it always shows up eventually. Markets reward asymmetry. They reward situations where your downside is controlled and your upside is allowed to expand. When you reverse that relationship, you are fighting the very principle that makes speculation viable. No amount of screen time or analysis can fix that. Look at your past trades honestly. Where did most of your damage come from? Was it from letting a strong position run too long, or from holding onto a bad one for too long? Most traders know the answer, even if they don't like it. The damage usually comes from a few oversized losses, not from missed profits. But missed profits matter because they are what should have offset those losses. If your winners were larger, those losses would hurt less. If your winners were allowed to mature, your equity curve would smooth out. Instead, many traders operate in a constant state of recovery, trying to make back what one trade took away. That's not trading. That's damage control. The market is not asking you to be perfect. It is asking you to be aligned with its structure. When price is moving in your favor and nothing on the chart says the move is over, exiting early is not caution. It is impatience. And impatience always shows up in the long-term numbers. So every time you grab a small profit, you should ask yourself what you're giving up in exchange. Are you protecting capital, or are you avoiding discomfort? Are you managing risk, or are you managing emotion? Because one of those builds a future in trading, and the other quietly undermines it trade by trade, loss by loss, until the math catches up, and the account tells the truth you've been avoiding all along. Most traders exit just as the real move is beginning, and that isn't an accident. It's a pattern as old as speculation itself. The market doesn't force them out, their own minds do. Price starts to move in their favor, and instead of letting the trade do its work, they rush to finish the job themselves. They confuse participation with completion. They think the goal is to be done, not to be right. At the beginning of a move, uncertainty is high. Breakouts fail. Trends stall. Everyone knows that. But once the market proves itself and starts behaving properly, something strange happens. The risk feels larger, not smaller. Why? Because now there is something to lose. Open profit creates attachment. It turns a chart into a personal matter. Have you felt that shift before? The early part of a real move is usually quiet. Price advances without drama. Volume confirms. Pullbacks are shallow. To the trained eye, this is exactly what you want to see, but to the average trader, it feels boring and fragile. There's no excitement yet, no big candles, no headlines. So when the first meaningful profit appears, they take it, believing they've captured the heart of the move. In reality, they've only touched the edge of it. The market has a cruel sense of timing. It often rewards patience only after it has exhausted impatience. The real expansion, the part that makes the trade worthwhile, tends to come after weak hands are gone. That's why moves accelerate later, not earlier. That's why the chart often looks most convincing right after you've sold. Ask yourself this: how many times have you exited a trade, only to watch price do exactly what you expected, just without you? This behavior isn't caused by lack of knowledge. Most traders know what a trend looks like. They know the signs of continuation. They can point them out easily on a chart after the fact. The problem is living through them in real time. Living through uncertainty is harder than analyzing certainty. When price pauses after an initial move, traders grow uneasy. They interpret consolidation as danger. They see sideways action and imagine reversal. But consolidation is often preparation. It's the market absorbing supply, building pressure. To stay in during that phase requires faith not in hope, but in observation. It requires trusting what the market is doing, not what you're afraid it might do. Exiting early feels like control. It feels like intelligence. You lock in a gain and remove risk. But what you're really doing is removing possibility. You're stepping aside before the market has revealed its true intention. You're saying, "This is enough?" Not because the move is over, but because your nerves are. The irony is that traders are most vulnerable to exiting early when they are right. When they are wrong, they hesitate. They wait. They rationalize. But when they are right, they rush. That imbalance shapes their entire career. Losses are allowed space. Profits are not. Over time, this guarantees frustration. Consider how trends develop. They don't reward prediction. They reward alignment. Once aligned, the trader's job is not to interfere, but interference is tempting. Every tick against your position feels louder once you have profit. Every pause feels suspicious. The mind starts scanning for reasons to exit, not because the chart demands it, but because the trader wants reassurance. Do you really think the market ends major moves exactly where you feel most comfortable? The real move often begins when disbelief turns into acceptance. Early profits belong to believers. Large profits belong to those who stay after belief becomes boring. That phase is quiet. It doesn't feel heroic. It feels like waiting while nothing dramatic happens. Most people don't associate that feeling with opportunity, so they leave. When traders exit early, they tell themselves they can always re-enter. That's another illusion. Re-entry is harder than entry. Price is higher, risk feels greater, and fear increases. What was once a calm hold becomes a stressful chase. Many traders never get back in. They watch the move continue and tell themselves stories about being cautious. But caution without context is just fear in disguise. Markets don't move to satisfy individual timelines. They unfold according to participation. When enough traders exit early, supply is cleared. That clearing is what allows the move to continue. In other words, your exit helps fuel the very move you wanted to profit from. That's the quiet irony of speculation. The trader who stays understands that discomfort is not a signal, it's a condition. The chart gives signals. Price gives signals. Structure gives signals. Your emotions give commentary, not instructions. Learning the difference is what separates those who catch fragments from those who catch trends. Think back to your biggest missed opportunities. Were they caused by bad analysis or by early exits? Most traders already know the answer. They saw the move. They anticipated it. They even participated in it, briefly. But they left before the market revealed its full hand. That's why equity curves often look like stair steps followed by long, flat periods. Small wins accumulate, then one loss erases them, then the cycle repeats. The missing ingredient is not intelligence, it's endurance. Endurance to stay when the trade stops being exciting and starts being uncomfortable. The market rarely rewards the moment you feel smartest. It rewards the moment you feel patient. And patience doesn't feel like confidence. It feels like sitting still while your mind looks for reasons to act. Most traders exit just as the real move is beginning, because the beginning of the real move doesn't feel real at all. The chart, not comfort, should decide when a trade ends, and that principle sounds simple until money is on the line. Before you enter a trade, everything feels orderly. You have rules, you have levels, you have reasons. The chart speaks clearly. But once the position moves in your favor, comfort starts to speak louder than price. That's when discipline is tested, not when you're planning, but when you're already involved. Comfort is a dangerous advisor in trading. It tells you to protect what you have, even when the market hasn't asked you to. It urges you to act, to do something, because doing nothing feels irresponsible. But in speculation, inactivity, while you are right, is often the most responsible action you can take. Have you ever noticed how uneasy it feels to simply hold a winning trade and let the chart unfold? The market communicates through structure, not sensation. Higher highs, higher lows, clean pullbacks, steady volume, these are facts. Your comfort level is not a fact, it's a reaction. When you allow comfort to dictate your exits, you shift from trading evidence to trading emotion. The chart becomes secondary. Your feelings take the lead. Most traders don't realize when this shift happens. They tell themselves they're being cautious, that they're locking in gains wisely. But if you exit a trade while the chart is still confirming your original thesis, you're not responding to information. You're responding to internal pressure, and internal pressure has nothing to do with market behavior. Think about how you enter trades. You wait for confirmation. You look for alignment. You demand proof. Why should exits be any different? Why should the standard suddenly drop the moment profit appears? Is profit really a reason to abandon structure? The chart doesn't change just because you're uncomfortable. A trend doesn't weaken because your heart rate rises. Price doesn't reverse because you're worried about giving something back. When you exit based on comfort, you're acting as if your emotions have predictive power. They don't. They only reflect your tolerance for uncertainty. Trading requires you to accept uncertainty even when you're right. Especially when you're right. Open profit introduces a new form of risk, not market risk, but psychological risk. The risk of regret, the risk of watching profit evaporate. That fear pushes traders to exit early, long before the chart suggests danger. Over time, this creates a habit of abandoning good trades prematurely. Ask yourself this: if the chart were hidden and only your comfort level was visible, would you trust that system? Professional traders learn to anchor decisions to external evidence. The chart is objective. It doesn't care how much you've made or lost. It doesn't know your goals or fears. It simply records transactions. That neutrality is its strength. When you let comfort override the chart, you replace neutrality with bias. Bias shows up in subtle ways. You start seeing weakness where there is none. A normal pullback looks threatening. Sideways action feels ominous. You interpret silence as danger. But the chart hasn't changed its story. Only your relationship to the trade has changed. Comfort-seeking behavior often leads to inconsistent results. Some trades you exit quickly. Others you hold longer. Not because the setups differ, but because your emotional state does. That inconsistency erodes confidence. You begin to doubt your own rules because you don't follow them consistently. The problem isn't the rules. It's when you choose not to obey them. The market rewards consistency, not clever improvisation. If your exit rules depend on how you feel that day, your results will reflect that instability. One day you'll feel bold, another day cautious. The chart remains the same, but your behavior doesn't. Over time, that mismatch costs more than any single bad trade. Comfort also creates a false sense of safety. You exit early, feel relieved, and tell yourself you avoided risk. But the real risk in trading is not temporary drawdown. It's long-term underperformance. It's failing to capitalize when the market offers opportunity. Comfort protects your emotions, not your equity curve. Look at strong trends historically. They don't end the moment they become profitable. They end when conditions shift, when momentum fades, when structure breaks, when participation changes. Those signals are visible on the chart. They are not subtle feelings. They are measurable behaviors. Ignoring them in favor of comfort is choosing subjectivity over evidence. Many traders say they want to be disciplined, but discipline isn't about doing what feels good. It's about doing what aligns with your method, especially when it feels uncomfortable. Exiting because the chart says the move is over requires discipline. Exiting because you're uneasy requires none. Have you noticed how often your best trades feel hardest to hold? That difficulty is not a warning sign. It's a feature of profitable trading. If holding winners were easy, everyone would do it. The discomfort is what filters participants. Those who can tolerate it stay. Those who can't exit and watch from the sidelines. The chart is the only referee in this game. It tells you when momentum is intact and when it's broken. It shows you when buyers are still in control and when sellers have taken over. Your comfort level offers no such information. It only tells you how exposed you feel. When you learn to separate feeling from fact, trading becomes clearer. Decisions become simpler, not easier, but simpler. You stop asking how much you've made and start asking whether the setup still exists. You stop managing emotions and start managing positions. That shift doesn't happen overnight. It comes from repetition, from reviewing trades and seeing the pattern, from realizing that the trades you regret most are rarely the ones that stopped you out. They are the ones you exited early because you wanted to feel safe. The chart doesn't promise safety. It offers opportunity. Comfort seeks certainty. Markets operate on probability. When you allow comfort to close your trades, you are choosing certainty over probability, relief over logic, and short-term calm over long-term growth. The chart will always tell you when a trade no longer deserves your capital, if you are willing to listen to it instead of to yourself. Cutting winners short quietly destroys long-term expectancy, and it does so without drama or warning. There's no single trade you can point to and say, that's where it went wrong. Instead, it's a slow leak, a habit. A pattern that feels harmless in the moment and devastating only when viewed over time. Most traders don't fail because they're reckless. They fail because they are consistently impatient with success. When a trade starts working, the mind immediately shifts. Before entry, you were analytical. You studied structure. You waited. You accepted risk. After entry, once price moves in your favor, the focus changes from market behavior to personal outcome. The question is no longer, what is the market doing? But how much can I lose if this turns? That subtle shift is where expectancy begins to erode. Have you noticed how quickly fear appears once you're right? A winning trade creates emotional pressure that a losing trade often doesn't. Losses feel familiar. Profits feel fragile. You start protecting something that was never guaranteed in the first place. That protection usually takes the form of an early exit. You tell yourself you're being prudent, but prudence that ignores probability is just fear wearing a respectable mask. Long-term expectancy is built on imbalance. Your winners must outweigh your losers, not in frequency, but in magnitude. That's the entire game. You can be wrong often and still succeed if your winners are allowed to grow. But when you consistently cut those winners short, you remove the very mechanism that makes trading viable. You reduce your edge trade by trade without ever realizing it. Most traders focus on win rate because it's emotionally comforting. It feels good to be right often. But expectancy doesn't care about how often you win. It cares about the relationship between average win and average loss. Cutting winners short shrinks that average win until it can no longer absorb inevitable losses. At that point, the strategy fails, even if the analysis is sound. Ask yourself honestly, how many of your best trades reached their full potential? When you look back, you'll likely find a pattern. Trades that went exactly as planned were exited early. Trades that went against you were given room. That asymmetry is not accidental. It comes from emotional wiring. Humans are loss averse. We fear giving back gains more than we fear missing opportunity. The market exploits that tendency relentlessly. Every time you exit a winning trade early, you reinforce a behavior. You teach yourself that relief is the goal. You feel good for a moment. You avoided discomfort. But you also trained your mind to associate profit, taking with safety rather than logic. Over time, that conditioning becomes automatic. You no longer ask whether the move is over. You exit because you feel like you should. The danger is that expectancy doesn't collapse all at once. It fades. You still have winning days. You still feel productive. But the account stops growing meaningfully. You find yourself working harder for the same results. More trades, more screen time, more effort, less progress. That's often the first sign that winners are being suffocated. Markets offer opportunity in bursts, not evenly. Most of the profit over a year comes from a small number of trades. If you cut those trades short, you are effectively trading noise. You're harvesting pennies and hoping they add up. Sometimes they do. Until one loss reminds you how fragile that approach is. Do you really think the market's largest moves are designed to be comfortable? Big moves test patience. They stall. They pull back. They make you question yourself. Cutting winners short avoids that test, but it also avoids the reward. Over time, traders who do this become very good at surviving and very bad at thriving. Their equity curve reflects it. Flat periods punctuated by setbacks. No sustained growth. Expectancy is not improved by activity. It's improved by alignment. Alignment between analysis and execution. Between plan and behavior. When you exit early for emotional reasons, you break that alignment. The plan becomes theoretical. Execution becomes reactive. One of the cruel ironies of trading is that the right trades often feel wrong to hold. They feel exposed. They feel uncertain. That discomfort is not a signal to exit. It's the cost of participation. Traders who don't pay that cost never access the full value of their edge. Think about how trends actually end. They don't end because you're nervous. They end because conditions change. Momentum fades. Structure breaks. Participation shifts. Those changes are visible. They don't require interpretation of feeling. When you cut a winner short before those changes occur, you are exiting on emotion, not information. That decision may protect your mood for the day, but it damages your results over time. Expectancy is patient. It waits. It doesn't punish immediately. It allows you to continue believing your approach is sound while quietly undermining it beneath the surface. Many traders spend years refining entries while ignoring exits. But exits determine profitability. A mediocre entry with a well-managed exit can be profitable. A perfect entry with a poor exit rarely is. Cutting winners short is an exit problem, not an entry problem. Have you ever noticed that your biggest regret trades are rarely losses? They're the trades that worked and could have worked more. The ones where the chart stayed strong and price continued without you. Those trades reveal the true cost of early exits, not just missed profit, but damaged confidence.